Guys, welcome to the Trading Academy day 38. Day 38, crazy, okay? In today's video, we are going to be talking about the inverse fair value gap model, okay? Told you guys how I was going to give you guys cookie cutter models. That pretty much means like models that you guys can take from this video and use it in the real markets or even in back testing. That way you guys can go and back test this data for yourself and get enough convictions so you can actually use it in the live markets. Again, if you guys enjoy this video, please leave me a sub, a comment. Let me know how I'm doing. Let me know how you guys like these videos, and leave me a like too. It really helps the channel out a lot, and I really appreciate I really appreciate you guys doing that. So yeah, the inverse fair value gap model is very, very simple. If you guys haven't seen my inverse fair value gap video, go ahead and watch that. And quick disclaimer, I don't really use this model as much as I should, to be honest, but I do have friends that are killing it with the inverse fair value gap model. It's very straightforward. It's a very, very simple model. And the models that I'm going to give you guys, and when I say models, I just mean like trading strategies, right? That you guys can just take and again, use it for back testing, meaning that you guys just go on the charts, look for that model and strategy, and collect data on it, so that way you guys can increase your conviction and confidence. So that way you guys can use it in live markets. Okay, and yeah, I'm basically going to start with like the simplest models and then go into the more advanced models. This honestly might be the last week for the academy, if I'm being honest, because I don't want to just drown you guys with a shit ton of models. I'm just going to give you guys, in my opinion, the best models to use in these live markets, and by far probably, yeah, just by far the best and most simplest models to use, and personally ones that I use. Like this one, I don't really use it as much. I did use it today, or I was trying to use it today, but unfortunately I did not get tapped in to my position because I was on NQ. But there was a beautiful one here on ES that I want to show you guys real quick, and then we can go into some more examples from like the past week or whatever. But yeah, I just want to show you guys very straightforward models that you guys can use in the live markets, and hopefully you guys can get funded and make some money with it. So let's get into it. So inverse fair value gaps, like I said, you want the inverse fair value gap, or you want the fair value gap that you want to target as the inverse fair value gap to sweep some sort of key level or go into a level, right? So for example, we have a low here, right? Boom, we have a low here on the lower time frames, right? If I go to the 1 minute here, you guys will see this here a lot better. On the 1 minute, there's a low right here. We ended up sweeping this sell side liquidity here after this huge candle. This is a CPI candle right here. This is the news that I told you guys not to trade and avoid, and just wait till market open or whatever. Market opens, we come down and we sweep it, and then we have the last fair value gap that causes that low, right? That's the one you want to mark out. That's going to be the most important one. I also have another video on my channel about this. This indicates if like the last fair value gap that sweeps the low or the high, right? That fair value gap is going to be important because that fair value gap is the last bullish, or in this case, it's a bearish PD array, a bearish fair value gap that sent price to go and sweep liquidity. So that fair value gap should, if price is going to continue bearish, right? If price is going to continue bearish from here, it should send price lower, okay? It should send price lower, right? Since this is the last fair value gap that swept the low, right? It should send price lower. But in this case, it doesn't, right? It reacts a little bit, right? We get a little reaction off of it, off this last fair value gap that sweeps the low. We get a little bit of a reaction here, but then we get this candle to close right above it, okay? So we also have a fair value gap up here, right? But that one doesn't really matter because this fair value gap here on the 1 minute is the last one that, before price swept the low, right? It's the last fair value gap before price swept low. We come back up, we retest it, we have some sort of little reaction here, and then this candle breaks through it, and then the following candle breaks through the second one, okay? And now we form a bullish one, and guess what? We respect it, right? Remember, institutional order flow. We're disrespecting bearish PD arrays and respecting bullish PD arrays. Also, a good way and a good thing to know about inverse fair value gaps is if your drawn liquidity is higher on the higher time frames, because you need to derive your ideas from the higher time frames in order for this strategy to work out beautifully, okay? So there was many ways you could have entered here, okay, on the 1 minute time frame. I don't like trading on the 1 minute, but I will sometimes. Okay. So once this candle closes here, you could definitely just market enter along right here and then place your stop at the swing point right here. Okay. And then you would just aim for, the buy side liquidity, or you can even take it to the higher time frame buy side liquidity. But most of the times, if you're trading on lower time frames, which these inverse fair value gaps work really, really well on, like the 1 minute, the 5 minute, because if you're on the 15 minute, the 1 hour, they still work. It's just your risk reward's going to be like a 1-to-1 or a 2R, which is still good, but like you're going to have to reduce your position sizing because most of the time those stops are going to be very, very wide. For example, like here, this is a 2R, which isn't bad. It's very, very good. If you were just to market enter here, as soon as this candle closed right here, you market enter, you place your stop, you place your TP right there. And then, yeah, that was a nice trade right there on the inverse fair value gap model, right? All you want to do and all you want to wait for is, again, like for this example here, we have the last fair value gap before sweeping the low. We come up, we close a body above it. So we disrespect the bearish PDA array. So you could market enter as soon as this candle closes. You can market enter right here. You place your stop down here at the swing low, or even this lower time frame swing low right here, the short-term swing low. You could place it right there as well. But, you want your trade to breathe a little bit in case it comes back down the inverse fair value gap, because sometimes this is a very high win rate model, but sometimes you will have losses in this model. Okay. Another thing I want to mention here on the 5 minute, there's another beautiful one here. So again, on the 5 minute, we have the same low here on the 1 minute, right? This is a 5 minute time frame. This fair value gap right here forms after we sweep this low and we close this candle. And then guess what happens, right? This 5 minute, like you don't even got to go to the 1 minute to catch these. You could stay on the 5 minute like I do, right? This one closes above the bearish fair value gap after sweeping this low here, right? Comes up, closes a body. So you can market enter as soon as this closes, or what you can do is just wait for a retest, right? And we also have a bullish fair value gap. Okay, when you have overlapping fair value gaps like this is called a balanced price range. Most of the time, price will come back into it and rebalance price, right? When we have two overlapping fair value gaps like this is called a balanced price range. All right, but we're focusing on the inverse fair value gap. Okay, we come down, we sweep the level, we push up, we tap into the inverse fair value gap, and you can market enter. You have two choices to market enter here. You can market enter as soon as the candle closes a body above it, and then you can place your stop below the candle's low that disrespects the bearish fair value gap, and then you would just target this high right here. Okay, like I said, this model here has a very high win rate, but you're sacrificing a lot in terms of like R, because you're mainly getting 1-to-1s and 1-to-2s or 2-to-1s. But again, if you enter like with two contracts, you can trim here and then just leave a runner and put stops to break even. And this would have worked out really, really well for you today. But yeah, you can enter as soon as the candle closes a body above this fair value gap here, or you can wait for a retest, which would give you a better risk reward, right? So if you waited for a retest here at the top of this inverse, and then you place your stop at the candle's low right here, you don't got to place your stop all the way down here. You can if you want, but usually I like placing my stop at the candle lows, and then you could target the high, and that gives you a 1.4 RR instead of a 1-to-1, right? And that's just one example from today. So today was obviously a very bullish day, and the reason for that is because institutional order flow on the higher time frames was very bullish. Okay, I'm gonna try to find you guys another example here on ES from, let's go to Friday. Actually, let's see if Friday gave us a pretty good one. I don't see anything here on the 5 minutes, but we'll find something here. Let's go Monday. Monday. Let's see, Tuesday. This was another nice one right here. Okay, so, all right. So here on Tuesday, which was yesterday, right? We have a fair value gap that formed right here. Okay, so price obviously went down to sweep liquidity, and it swept all this liquidity here, right? It swept these lows right here, these equal lows that ES had, right? Swept those lows, and then I also swept this liquidity over here, right? One of the Thursday lows from last week. Okay, so we swept all that, and then we closed back within this range right here, right? We closed above this these equal lows right here, which is a good sign, right? And then this next candle forms, and then we form a fair value gap, okay? So if we're truly bearish, okay, and we're not bullish, this should have a reaction to make a lower low, okay? It should have a reaction to make a lower low. That wasn't the case here. This is on the 5-minute time frame. I guarantee you, if we go to the 1 minute, we'll probably find one as well, and we will right now. But the 5-minute fair value gap, right? We come up. We already swept key levels, right? We swept liquidity here at these equal lows right here. And now we're pushing back up. We're closing in the range. We form a fair value gap, bearish one. Now, this fair value gap here should be the one that sends us lower, but it isn't, right? We have nice reactions. We close a body right above the fair value gap barely, and then we come back and we retest it. Another telltale sign about inverse fair value gaps, especially these bearish ones, is if an opposing PD array forms in that PD array, meaning like this bearish fair value gap, we have this, right? We're reacting in it, and now we close a body above it. Again, you can market enter here if you'd like, but again, we just swept liquidity here, so I would just wait for market open, which opens here. And we're obviously respecting the midpoint of this inverse fair value gap. Like I said, though, when you have a fair value gap and the opposing PD array forms in that fair value gap, like this case, we have a bearish one, and then we have a bullish PD array forming in that bearish one, that's a good sign that the bullish one is going to be respected. You don't want to see that. If you're bearish, you do not want to see a fair value gap, a bullish one form in the bearish one. You just don't want to see that, okay? But as you guys can see here, the midpoint of this fair value gap is being respected. As you guys see here, over here on this price action, this was being respected. It came down, and now we pushed up. We closed the body above it, and now we're respecting the midpoint of the inverse, right? We pretty much flipped it, right? This was resistance. We flipped it to support. We have a bullish PD array right here, bullish fair value gap that's being respected also on top of all that. And now our drawn liquidity should be higher, right? And then it pushes higher, pushes higher, pushes higher. And again, we have another fair value gap right here, another inverse, right, on the bullish side. So we have a bullish fair value gap here that sent price to what? To go make a high, right? And we swept liquidity here. We formed a fair value gap to go higher. We come back, and then we close a body below it. We come and sweep all these lows over here. And now we go up and revisit it, okay? We revisit that fair value gap, this inverse fair value gap, this bullish one, right? That failed. We come back, we retest it, right? We're not closing above the midpoint except for here. And then right away, right after we closed above the midpoint, the next candle, boom, goes all the way down and disrespects this bullish PD array, okay? So if I mark out this bullish fair value gap here, boom, okay. We get a closure below it, and then we respect it, right? We inverse it. And now this is where you can go short and target this low down here. In this example here, I would not go short all the way down here because this is a very violent move, and you've already swept liquidity here, okay? I would not go short when it closes all the way down here. The only times I would like market enter when a body closes above or below a fair value gap is if it closes like near the fair value gap, if that makes sense. Kind of like right here, right? When it closes near it, this is where I would consider market entering. But again, you did sweep liquidity. So in this case, I would wait for market open, and you get more confirmations here because it's respecting that midpoint of the inverse fair value gap. But when you have an example like this, where it closes all the way down here, a body, you don't want to short the bottom, right? You want to just wait for more confirmation. And most of the time it comes up, right? It comes up and retests this bullish fair value gap that failed. Most of the time, the reason for that is because this one just had a very violent move. So it needs to come up and rebalance everything. And it does just that. And then we come down, we disrespect the bullish fair value gap here. And this is where I would consider shorting right here. As soon as we close a body right here, you could short right there. You could place your stop above these highs because it shouldn't get back up to there. And then you can target these lows right here, or you can target even lower, like right here. And as you guys can see here, has a very low RR, right? Your stop is actually a little more than your reward. But again, this model has a very high win rate. Like if you would have went long here, you would have went longs anywhere right here in this inverse, and then you place your stop below this low or this short-term swing low, and then you targeted like this internal high right here. This would have been a 1.5. Okay. Again, this model has a very high win rate, but the RR is going to be very low. It's going to be a 1-to-1, 1.5, 2 at best. Okay. Let me see if I can find another one more before I let you guys go. Let's see. So we sweep the low down here. Okay, we sweep the low. Let me go to the 1 minute real quick. Let's see if we can find something on the 1 minute. So we sweep the low here. There's no bearish fair value gaps or anything forming here on the 5 minute. If we look at this fair value gap here, we pull this out. You can see that this bearish fair value gap was respected, and this inverse bullish fair value gap that we just used a second ago was respected as well. But this bearish one, if you just look at this, because we're looking at bearish fair value gaps to be inversed if the order flow is switching to bullish, right? We're looking at bearish fair value gaps to be inversed. So here we close a body above it. You can mark your enter there and place your stop below here. Okay, this fair value gap down here should not be tapped into if we're disrespecting a bearish fair value gap. We get the tap of this bearish fair value gap, so that's the one you would use. We get the tap at the lower end of this fair value gap. So once we close a body above this, you guys can mark enter there, place your stop below this candle's low or this candle's low, right? Either one works, and then you would target the drawn liquidity, and then you get a solid 1.67 R, which is good. All right, and especially if you have runners, you could just leave this running, which would be a nice risk reward there. Okay, but that is pretty much the inverse fair value gap model. Just to summarize, right? Let me go ahead and draw something up for you guys just to summarize up this model real quick. So first, right, first rule of thumb. You want to wait for price to sweep an important key level, whether it be sell side, buy side, whatever. You want to wait for price to sweep, right? Now you want to look for the fair value gap that formed after the sweep or before the sweep. So let's say that we have the last fair value gap before sweeping the low, it forms whatever, and then we have price displacing above, and we close a body above the last fair value gap before sweeping the low or after sweeping the low. And then basically what you want to do is either market long right when the body candle closes above it and aim for whatever opposing liquidity is left up here. An important thing is making sure that higher time frame institutional order flow is in the direction you're looking to take the trade. Okay, so what you want to look for again is either you can market enter at the inverse fair value gap or right when we close the body above it, or you can wait for a retest and then go higher. Okay, which would give you a better risk to reward. But yeah, guys, hope you guys enjoyed the video. That is the inverse fair value gap model. Pretty straightforward. It's very easy. All you need is just fair value gaps and then making sure that your drawn liquidity is going to be higher or whatever your drawn liquidity is when you're trading. And then that's it. That's all you really got to know is just aim for the drawn liquidity and then use the inverse fair value gaps, right? But yeah, hope you guys enjoyed the inverse fair value gap model. Pretty straightforward. If you guys enjoyed it, please leave me a like, comment, subscribe, and I'll catch you guys in tomorrow's video where we go over the unicorn model, which is one of my favorite ones. So catch you guys tomorrow. Peace out.